Good day and welcome to the First Property Group plc Interim Results Conference Call. Today's conference is being recorded. On the call today is Ben Habib, Chief Executive Officer, George Digby, Finance Director, and Jeremy Barkis, Business Development Director. Please go ahead.
Hi, good morning everyone. Thank you very much for listening into the presentation that we're making on our results for the 6 months to 30th September 2018. As already mentioned, I'm joined by my colleagues George Digby, Finance Director, and Jeremy Barkis, Business Development Director. I'm going to hand over, I normally do this call, but I think it's much better for those who've actually done the legwork and putting the presentation together and put the numbers together to actually do the call, at least the majority of the calls themselves. And then I'll take questions at the end if anyone has any questions. So without further ado, I'm going to hand over to Jeremy Barkis, who's going to skip through the results in a very comprehensive but succinct manner, and George Digby to chirp in whenever there's something pertinent to say on the numbers. Over to you, Jeremy.
Great, thank you, Ben. The presentation is on our website. If you go to the media section and look under presentations, you'll see it there. So I'm going to skip the first few pages of the presentation, which describes First Property Group. I'm assuming you are familiar with us, until we get to page 6, which just outlines our structure. And if you recall, we have 2 divisions: the fund management division, which is growing very rapidly. It now has 551 million of third-party assets under management. And then there's our group properties division, which contributes most of the profits to the group. That has a smaller, obviously, amount under management, 178 million now, giving us a total assets under management of 730 million. So moving to the financial highlights, our revenue was down by about 1 million in the first half, which is about 7%, and it generated a statutory profit before tax of 3.8 million, down about 23%. The reason for that is virtually entirely due to a vacancy that we got in one of our 2 towers in Warsaw called Hunskiego 8, or CH8 as it's known as, which we flagged at the time of the preliminary results in June. That vacancy came about in February of this year, and so for the first half we've actually had pretty much no contribution from that. But we are making good progress in reletting. 30% of it has been, we've signed leases for, and another half of it we're very close to signing leases for. So this dip in profits should only be temporary. The diluted earnings per share, 1.69 pence, down by more than the statutory profit before tax. But the explanation for that is partly to do with the fact that we have been selling down, because we consolidate one of our funds, Equitable Opportunities plc, and we've been selling down our stake in that fund. There has been a larger contribution from the parts that we don't own that needs to come out of these results. You won't see that in the full year results because we have now sold down to below 50%, and we can deconsolidate that. So from going forward from the prelims onwards, our results should be a lot simpler, but that's the explanation for the reduced EPS being down by more than the statutory, well, the majority of the explanation for the reduced EPS being down by more than the statutory profit before tax. But our cash generation remains very good, and as a result of that, the directors got the confidence to recommend a higher interim dividend. So that's up just short of 5%. And it's worthy of note that, skipping slightly here, that our cash balances have remained unchanged from a year ago, despite investments over the last year of 5 million quid. Including buying 3.2 million quid worth of shares back into the company, making various investments in our funds. So the net assets per share were up 10% on a book cost basis. It's our accounting policy to carry our properties and investments at the lower cost or market value. But when adjusted to market value, they were up by 21% to 62.21 pence per share. And the main explanation for that, and we'll get into detail later on, is due to an investment we made in Krakow Business Park. Moving on to page 9 and the group properties. So this gives some aggregate detail actually to the per share detail that I've just been running through, but so I think I won't go into too much detail here. We'll do this later on when we get to the group properties section. And a very pleasing increase in assets under management. They're up by 30% over the last year, but and even in the last 6 months they're up by 20%, and that is mainly driven partly by continued investment in the UK on behalf of the Officers Fund that we raised in July 2017, and the raising of 2 new funds in Central Europe, one in Poland, which was the FPROP Phoenix Fund, and one in Romania, FPROP Cluj. So just to put some of these numbers into pictures, that growth in our net assets since 2006 is a pretty impressive chart. It's one that we're understandably proud of. The orange segment of the chart shows our net asset value, that's the carried net asset value, and then the grey section shows if you were to adjust it to market values, where it would be, and you can see it's up there, 62 pence. The growth in our adjusted net assets, when you include the dividends that you pay, is actually up by 28% per annum on an annualized basis, i.e. per annum effectively, since 2006. Another very pleasing chart on page 11 that shows our dividend growth. Another thing that we're very proud of. What this graph does not show is that we've had continued dividend growth throughout the credit crunch, despite being a leveraged property investment company. And again, nudging the dividend up a little bit by about just shy of 5% at the interim stage. So moving on to page 13, which shows the split between the 2 divisions that I referred to earlier. So, as I said, the bulk of the contribution to our earnings comes from our group properties division, and that is down from 6 odd million last year to 4.25 million in the first half of this year. And the explanation for that, as I mentioned, is to do with this vacant 10,000 square metres that we got back in one of our 2,000 Warsaw. And I'll go into a bit more detail when we go into the group property segment. And then you've got the contribution from the fund management division that is flat on last year. And again, when we get into the fund management section, you'll see that there is a time lag between our fast growth in assets under management and the revenue that follows through from that. So moving firstly into the fund management division. So you can see 800 grand of profit before tax in the first half prior to the deduction of unallocated central overheads. But if you look on page 15, you can see with the blue line the sharp growth in assets under management. And the main explanation why the revenue has not followed that blue line upwards is the fund that we raised in July of last year, FPROP Offices, for which we've now invested some £120 million. We agreed a profit share arrangement in lieu of management fees. And in the UK, standard purchaser's cost when buying commercial property is 6.8%. And so we have to have generated enough profit to overcome that hurdle of 6.8% before we can start to accrue our share. But in the second half of this year, we expect to start accruing for that. So you should therefore start to see the contribution from fund management increase. The annualized rate at which we were earning fund management fee income at 30th of September was 2.9 million, and that excludes any contribution from the Escrow Officers Fund. But as our assets under management have grown, likewise, so has our weighted average fund management contract term. So we've now got 6.3 years of fund management contracts, over 100 clients. And these clients range from, well, we'll come to that actually. So page 16 shows you the split of our funds. The largest being the one that we manage on behalf of the Shipbuilding Industries Pension Fund at 22% of our assets under management. Escrow Officers at 20%, that is growing. Both those funds are managed on behalf of pension funds, as is UK PPP. So you can see when you look at the next page, 17, that actually 76% of our client base is managed on behalf of pension funds, with the roughly 10% each, or 9 and 10% for the private clients and endowments. As far as the endowment clients, we've got some very prestigious endowment clients ranging from mainly Oxford and Cambridge colleges. And you can see there also the split of our funds under management. The growth of the new funds in the 6 months that have just passed was we had about 80 odd million euros of new funds in Central Europe, and we invested about 30 million, I think, since the year end in the UK on behalf of Escrow Officers. And then moving into the other segment, which delivers the lion's share of our profits at the moment, the group properties, our own balance sheet earnings. It's our wish to grow the fund management section so that the contribution between the two is more even. But this is a very, very healthy contribution from our group property section. If you look at page 19, you can see the split from the grey bit at the top are the 14 properties that we either own directly, we own 5 of them directly, or there are another 5 that we own through Escrow Opportunities PLC, where at the period end we were the majority shareholder with a 51% share, which is why they're consolidated into our results. But actually, since the period end, on the 12th of October, we've sold more of our shares in that fund, and so we're now down to about a 44% share, and that's the orange contribution in the middle, and then the bottom bit, the dark grey, is our share of the minority shareholdings that we have in the funds that we manage, and we have 9 minority shareholdings in the 13 funds that we manage. And looking forward to the preliminary results in June for the full year to the 31st of March, you'll see a bigger contribution there because the orange and the dark grey will be merged, but obviously the orange will be smaller because it will be just our, so it will be accounted for our share as an associate. This page 20 is quite an important page because it, given that the group properties contribution is so large, this explains how the cash flows from those group properties. And what I'm talking about again is just the 14 properties, the 5 we own directly, the 5 that we own through Escrow Opportunities that we consolidate, but we'll stop consolidating with effect the 12th of October, and then there's another 4, but they're quite small, in a couple of funds that we manage called Regional Property Trading and ENS Estates that we bought in during the period. So they generate 7.9 million of rent in the first 6 months, that's euros, and the interest expense servicing, the interest expense associated with that rent was $1.58 million, million euros, which resulted in a 6.3 million euro net operating income. The tax rate in Poland is 19%, but by the time you depreciate the properties, the effective rate is about 14%, so our tax charge there is 360,000. The debt amortization line, this is the key line. You can see that we are repaying a lot of debt every year. So in the first half, nearly €4 million of debt was repaid, and we also have capital expenditure associated with these properties, particularly as we re-let the vacant space that we have in Hammond's-Gate 8. We put the CapEx going forward associated with those re-lettings as well, generating 1.36 million of free cash. A value of 200 million. The LTV, some people may consider high at 67%. We don't consider it high, particularly given the headroom between the amount of interest, what it costs to service those loans, 40% of which are fixed, and the amount of rental income that we get on top of that. And bearing in mind, this is that rental income excluded the vacant space at Hammond's-Gate 8, but obviously we still have to pay the interest on that vacant space. So you can see that there's very healthy headroom between our cost of debt servicing and the amount of income coming in. But you can see from the bottom there that the vacancy rate has jumped up to 15% of our group properties, and again, it's all because of this temporary situation at this large office building in Warsaw. This might be a good opportunity just to talk about the office letting market in Warsaw. There's been a lot of development over recent years, but actually, interestingly, the availability of space is reducing, and the vacancy rate, which has been in the teens for the last several years, is now in the central parts of Warsaw down to single digits, 8 or 9%. So we're confident that it's in line with what we're experiencing in our efforts to re-let that vacant space that we have in Hammond's-Gate 8. I mentioned that about the loans. So we raise these loans in separate SPVs that are non-cross-collateralized, so they're not cross-collateralized and there's no recourse to the group on these loans. The weighted average borrowing cost is very manageable at 2.83%, and a 1% increase in the base rate would increase our annual interest bill by 650,000. Again, very manageable in the context of the cash being generated from these properties. And the yields as well, as you can see, that the valuations at 8% is not demanded. Yeah, effectively.
Yeah, close on. I mean, there's no purchase cost, obviously, because it's on value, but it's the net operating income divided by the value of the properties.
And just on the point about the obviously what would be the lifetime growth?
On excluding that downward movement, I'd say there's been very little rental growth across the rest of the portfolio. It's sort of steady as she goes. One of the drawbacks with Poland is that, as Jeremy mentioned, quite a lot of development has been taking place. So rents have basically had a lid kept on them. Every time you try and raise your rent, there's a new building that shoots up that, puts a lid back on them. Most of the buildings we've bought are let at rent below the sort of brand new shiny buildings. So we've had, with the exception of this vacancy, we've had pretty much 100% occupancy through our buildings. But actually ratcheting rents up has been quite difficult with all this new supply coming on.
But we've maintained, as Ben said, to maintain that high level of occupancy throughout this period of big development is quite an achievement. And the reason why we've been able to maintain this very, very high level of occupancy right up until this vacancy in February is because we offer well-located but cheap offices in very good locations. Yeah. So there's always a lot of people like value. Page 22 lists our main tenants, and really they should be recognisable for most UK investors, with the exception perhaps of SECO, which is a Warsaw 30 stock exchange listed company, which is a tenant in our office building in Gdynia up in the north of Poland on the Baltic coast, and NSZ, that's the fifth one, which is a health, it's like the national health in Poland. And perhaps 8 and 9 are less recognisable, but they're nonetheless good tenants, and LPP brands are even on Oxford Street now. Page 23 shows you how our 14, what share of the NAV our 14 properties make up, and the largest one being Halminskiego 8, where we've got this vacancy, is 22% by value of the group, of the 14 properties that we own. And as you can see from the smaller pie chart on the right, the bulk of the value is in Poland. And then, just coming on quickly to markets, the rate of economic expansion in Poland continues to motor some power on. It's expected to grow by, GDP is expected to grow by 5% this year. Inflation is manageable, government debt is low by international standards. It means that there is a constantly growing demand for commercial property, which has been met very adequately, or more than adequately in some cases, by a corresponding increase in supply. But we've navigated very well by investing in those properties which are slightly higher yielding, enabling us to offer slightly lower rents, certainly for offices, and therefore maintain for lots of company. And in retail, we tend to invest in, again, or areas where there is less.
When you have a category killer shopping centre, we want to invest in the dominant retail centre in a given location, so that you're not vulnerable to new development.
The debt market remains extremely well functioning in Poland. You can take out loans pretty easily of 2.5% margins above Euribor. You can fix your Euribor. So it's a good functioning commercial property market. It turns over 5 or 6 billion euros a year. And the segment that we operate in, which is a slightly high yielding area, enables us to generate these very high returns. Romania similarly has been an economic success story in recent times. In fact, its GDP growth is set to exceed 7% this year, but it should slow down thereafter. The commercial property market is smaller there. It turns over just shy of €1 billion a year. It's got a similar profile to Poland in that there is a lot of development to meet the increased demand for office and retail and commercial space, which has kept a lid on rents, and so and the debt market there, which is much shallower. The margins are beginning to come in, which should lead to greater liquidity in due course, but it's not as developed as the Polish market, which means that our activities in Romania are much more limited, as you can tell by our assets under management. It makes it hard. We need to invest in properties with a commensurately higher yield to compensate for the greater illiquidity and the higher debt servicing costs. But we do find them occasionally and make spectacular returns from them. And in the UK, and everyone's got their own views on what's going on politically. Certainly it's uncertain to say the least. But the economy seems reasonably robust. I think there is a general slowdown everywhere actually. But we remain confident about the segment of the market in which we're investing, which is secondary offices. The supply of these has diminished in recent years as a number of them have been converted from office space to residential, and the economy is growing, and so if you're able to buy these at yields and at stable rent levels, we remain confident that the deep market the outlook is good. So in summary, it has been a good first half for the group, again, notwithstanding the reduced contribution from Halminskiego 8, which is a temporary situation that we are making good progress in overcoming. But the growth in our third-party funds under management has been fantastic, 44% from the prior year, and the growth in our adjusted net assets, similarly, has been fantastic. And I perhaps should have spent a bit more time talking about that, and it relates to the fund that we raised in June of this year, which was investing in an office park in Krakow, which has got some problems associated with it. We actually bought it from the administrator prior to raising third-party funds. We had to, the office park was actually in default of its loan, so we were able to buy it from the administrator for about €1 million. But we refinanced the non-performing loans, or we turned the non-performing loans into performing loans, or the bank, we renegotiated the bank debt and raised third-party funds, and the last valuation on that by CBRE was at €72 million, and that essentially experienced the uplift. We'll get our first formal valuation since our acquisition as at 31st of December this year. And so at the moment we're going off the old one. This was commissioned by the banks who had the underwater loans. But we're making good progress there in repositioning that park, and we think that we can make it into one of the most attractive business parks in Krakow, that's very close to
Poland. And so it'll be one of the best parks in Europe when we're done with it. It might make you laugh, but that's true.
We're doing things like putting in sports facilities. There's a gym, there's roaming matters.
There's going to be a gym, there is a gym, there's going to be a sports facility, there's a free bus service, there's more than adequate car parking, there is first-class office buildings, floor-to-ceiling height of 3 meters, raised floors, suspended ceilings, LED lighting, intelligent lifts, voice-over systems for exiting in the event of a fire, its own local station, frequent train service to Krakow. I mean, that is an absolutely fantastic business park.
That's a very important point, I think, having its own train station.
Yes, everything I've said is very important. And close to the airport, 5 minutes to the airport, there's nothing wanting about that park with the exception of tenants. And we just need some tenants to turn up, which we will have in due course, and then it will be an all singing, all dancing, fully let scheme, of which we will be very, very proud.
And that could be a major contributor to our earnings going forward.
Yeah.
As should the reletting of Hammondsgate 8, as should the beginning of FPROP offices starting to contribute.
The income stream from offices coming on tap.
Group offices. Yeah. You can see that actually we could be at a bit of an inflection point here with regards to all these new sources of cash coming on stream. And you can see it already in the growth of the AUM, but not the following up yet, because the revenue seems to accompany that.
Good. Should we open it up to questions then?
Yeah.
At that point.
Thank you.
Are you able to start on the telephone? Yeah.
Thank you. If you would like to ask a question, please signal by pressing *1 on your telephone keypad. If you are using a speakerphone, please make sure your mute function is turned off to allow your signal to reach our equipment. A voice prompt on the phone line will indicate when your line is open. Please state your name before posing your question. Again, press *1 to ask a question. We'll pause for a moment to allow everybody to signal for questions. We will take our first question. Please go ahead, caller. Your line is open.
Yeah, hi, it's Chris Thomas. How you doing, guys?
Well, so there is a real human being on the other end of this telephone.
Yeah, they do exist. Yeah. Your Krakow business partner sounds very interesting. Can you sort of give us flesh it out a bit both in terms of what's been built, how much of it is occupied, what your share is, and how much more space you think the park can accommodate in due course, and what the investment will be when you do build it out?
So we own 4 office blocks, Chris, with an aggregate space of 50,000 square metres. Half of that is vacant, half of that is let. The net operating income at the moment is about €2.5 million coming off the park. and we expect once those 4 buildings are fully let, that the NOI will rise to about 7 million, roughly, give or take.
Okay. And what's your share? This is one of your sort of group investments, isn't it?
It's an associate investment. We own 23% of it.
23%.
We bought the whole thing for €1 million back in September 2017. The bank loan was in default. We spent 9 months renegotiating the loan terms to put in place a new bank loan. We raised €33 million of equity commitment at the same time, in return for handing over 77% of the interest in the park. So we retained 23% of the park for a net investment of €1 million, and there's no requirement of First Property Group to invest further to maintain our 23%. So that all the capex money required is coming from third-party investors.
Okay. Did the bank take a haircut in that process?
No, they didn't take a haircut. We've got very soft debt terms, 1.85% over Euribor, 2 years interest only, no debt ammo, no covenants for the first 2 years, no LTV or DSCR covenants for the first 2 years. And a sympathetic approach from the bank to allow us to reposition the park.
Okay, yeah. And in terms of the ultimate potential, there's more space, presumably, is there?
Yeah, so we also bought 3 plots on the park, some of which could be redeveloped for, new buildings. We're also plaintiffs in we've inherited some actions which have been instituted by the receiver before we bought it, for the restitution of plots which are allegedly fraudulently stolen from the previous owners of the park. They would come back to us if we succeed in those actions. And we're pretty confident actually we will succeed. The principal perpetrator of these alleged frauds is in jail and under criminal investigation because of what he's been up to at the park. So we would expect those plots to come back to us, and that will be further upside. And then there's other scope for growth as well on the park. So we're very excited about it.
Yeah, it sounds very interesting. Brilliant. Well done. Many more gems like that floating around?
Sorry?
Are there more gems like that to be found?
Well, we've got a sort of taste for it. Now that we've done it once, it's been quite, you learn as you go, and I think what's been quite good for us in the market is that people have seen that First Property Group is able, within a week to step up and buy something of that significance and take a view. All our competitors who were kind of looking at the park were standing slightly with their, caught in the headlights of the complications of dealing with the Polish administration. And we just tipped up with €1 million. We didn't tip up with $1 million. We tipped up with $250,000, and then we were made to come up with the extra 3/4 over the period of a week. And we bought it, and we just took a view on the debt, which was a bit ballsy, I suppose. But it's proven to be a very good thing that we did. And if we could do more of those, we will.
Right.
This park was allegedly the subject of an offer in 2007 that was turned down of 125 or 130 million euros. So obviously it was fully let at that stage.
The scope for capital value growth is significant.
Yeah.
Yeah. And it looks a really great deal. Classic first prop acquisition. Well done.
Yeah, thank you, Chris.
As a reminder, if you would like to ask...
And by the way, Chris, for listening. Thank you. Any other questions on the phone?
Our next question, please go ahead. Your line is open.
Thank you. It's Giles Sharp from Albany Sharp. Good morning.
Hi.
And a nice set of figures. Well done. Although I thought the dividend was a bit mean, but a good set of figures. But tell me, you might have answered this, and I just didn't pick it up. But what did the vacancy cost you in the first 6 months of the year in Warsaw?
Well, we lost about €1.5 million worth of income. but it probably cost us around 2 million, really, because you lose the recoverability of costs.
Right. And so, when do you think you're going to, I know you're talking quite optimistically about you'll be able to fill this up pretty quickly, but how quickly are we talking? It's now in November. Are we talking about early 2019?
I think we're talking about late 2019.
Okay.
It's remarkable speed at which we've let it anyway, Giles. If you think about 10,000 square meters is 110,000 square feet. It sort of sounds more when you put it into square feet. And we've let 30% of that. We've got 50% under offer. Some of those deals may or may not come to fruition, but it's very, very speedy repositioning of the asset, which is testimony to the strength of the Polish economy, I think.
Right.
And the
also
yeah.
I'm sorry.
Yeah. And obviously speaks to the as well, speaks to the property and the strength of the Polish economy, yeah.
Yeah. Well, it all sounds very positive. There's a question I've asked you before, but I'll have to ask it again, and that's the question of how to value this group. I mean, it's more and more a fund manager, yes?
I think so, but every time, we make strides recently in growing our AUM on the fund management side, we also somehow manage to make capital profits by trading in property, as we've just done with buying this business park in Krakow. So, I think we're unashamedly a hybrid, and the market needs to determine whether it prefers to look at us on a NAV basis or on a multiple of earnings or a bit of both. I would have thought we should be a bit of both. My own view would be to take NAV and apply whatever percentage of NAV you think is appropriate for a property company, and then put a multiple on our fund management income and add that to the NAV. Add that to your value of NAV, and you should end up with. But it's not for me to comment on whether the share price is high or low. But just our NAV at the moment is 62p, and the share price is 50 this morning, which suggests we're at a pretty significant discount to NAV, and which also suggests that none of our asset management income is being valued.
No. Look, thank you very much indeed. Best wishes for today. We need a bit of optimism around, and you've certainly given us that. Thank you.
We are very optimistic. No one's asked about Brexit, but we're very optimistic about Brexit as well.
Good. I hope our Prime Minister is going to come back with something, but I'll leave you to it, and thank you.
Thank you very much for listening, Giles. Thank you.
As a reminder, if you would like to ask a question, please press *1 on your telephone keypad. We'll pause for a moment to allow those to queue for questions. It appears there are no further questions at this time. I'd like to turn the conference back to you for any additional or closing remarks.
I've got no remarks really of a closing nature. Any questions in the room that you'd like to take now? Or
You can maybe take them after.
Yeah, okay, let's do them after. I think we'll bring the call to a close then in that case, I think.
This concludes
Great, thank you very much everyone.
Thank you for your participation. You may now disconnect.